Hello, everybody. This is Ken Leon, Director of Equity Research at CFRA, and we are really excited to have you join us today to really cover strong starts, favorable finishes. It's our second half 2021 outlook. Helping us today and putting this event together is Dawn Vang, and she'll be steering our slides. Next slide, please, Dawn. Our presenters today are Sam Stovall, who will kick it off, and he's our Chief Investment Strategist. Elizabeth Vermillion is our Equity Analyst in the Industrial Sector. Richard Wolfe, Equity Analyst in Materials. Each of them will be highlighting some very interesting themes. Elizabeth on infrastructure, Richard on in the materials chemicals, and also the impact from inflation. And Todd Rosenbluth, head of ETF and mutual fund research, will be covering everything in terms of outlook and also our views about the ETF market batting fourth. Next slide, please. A little bit about CFRA for those who are first joining us on these webinars. We do them regularly. CFRA has over 90 years of innovation and growth. We're one of the largest independent research firms globally. The firm has a long history in fundamental research and really took off in October 2016 with the acquisition of the S&P Equity and Fund Research that cobbled together with our great expertise in terms of forensic accounting. We have made subsequent acquisitions which have really bolstered our capability. In CFRA acquired First Bridge Data for ETF for data and analytics, which Todd may reference, and just most recently this year acquiring Lowry Research, well known in the market for its technical research. Next slide, please. So CFRA, the greatest thing about our firm is every dollar is invested in terms of into our research, and it's the ability of our analysts, whether it be in fundamental research or forensic or ETF and mutual fund, really take advantage of our great platform, our ability to really understand and articulate interesting observations from the deep dives we do on data and analytics, our ability really with our scale of coverage, which is over 1,500 stocks globally by our equity analysts, and also using our database and other diagnostics like risk mitigation from the forensic team. We also are, we think, uniquely positioned for the wealth management market because we have an integrated approach from Sam's leadership in terms of market views and macro down to the bottom-up work that our analysts do on company coverage, and in terms of being actionable, not only in terms of single stocks, but also Todd's leadership as it relates to ETF and mutual fund ratings. We have methodologies that really speaks to how we approach things. In equity research, it's expectation methodology. We have model portfolios, and every Monday, we send out from marketing our thematic research along with Sam Stovall's Sector Watch and Todd's work on idea generation. Next slide, please. So today's agenda, just again going through this, Sam's going to kick off on the equity market, Elizabeth on infrastructure spending, as well as machinery and engineering. Richard will cover materials and chemicals, and there's actually four sub-industries for chemicals. And Todd's going to, again, finish up talking about bringing it back on what's inside for ETF matters. So with that, let me turn it over to Sam.
Well, thank you, Ken, and hello, everybody. Before I get started, let's just mention the disclaimer that the presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. But let's go to the first slide because that is the title slide that tells us what I'm going to be talking about. Strong start, favorable finish. And that really is because this is data that the market has been delivering to us through this first half that does indicate historically whenever we have had a strong start, doesn't mean we have expended valuable energy, but rather we get a running start to the remainder of the year. In terms of my agenda, I'm going to start with saying where we have been. We need to see where we've been, in my opinion, before we get a better feel for where we can go. Talk about sector returns versus history. And again, I think you'll hear that history in some ways repeats, but other ways rhymes. Talking about these specific milestones, what was it that indicated that we could end up with a good year? And then obviously discuss those factors that people are concerned with in terms of the fundamentals, in terms of economic outlook, earnings projections, what could get in the way in terms of inflation, interest rates, et cetera, and could it be as bad as the 1970s all over again? So let's get started with the next slide, titled Where We've Been. And these are price returns since the last S&P 500 decline in excess of 5%. We fell almost 10% that ended September 23rd of September 23rd of 2020, and then where we have been since our most recent high. And what you can see is that all sizes, styles, and sectors within the S&P 1500 were in positive territory, led by small cap and mid cap stocks, value stocks, but very interestingly by energy, financials, materials, and industrials. And I'll tell you in a minute why I'm emphasizing these four sectors. We've also had 99% of the sub-industries in positive territory since the end of September. Poor household products, the only group to post a decline during this period. But if we go to the next slide, you'll see why I emphasized energy, financials, materials, and industrials, and actually in that order. Because going back to 1970, what I did was I looked at every month in which we had a steepening yield curve where it was the 10-year yield minus the 1-year yield. And in those months in which we had a steepening yield curve, which were the best performing sectors? How did they perform on a total return basis? And it was energy, financials, materials, and industrials that were the best performers. Large caps, small caps, sort of in the middle, whereas you had consumer stocks on either side of the benchmark. But then your more conservative healthcare, utilities, real estate, which early on end up being bond proxies and therefore suffer in a rising rate environment, were the ones that were still positive, just not as positive as some of the other sectors. So where do we go from here? Let's take a look at the next slide, market milestones. And what we see from this table are four different indicators. The market milestone of we had 10 plus new highs through the end of February. And I show what was the full year return for this indicator. How did it perform in the second half? And then most particularly in the fourth quarter. And you can see why they're market milestones. Whenever we've had such a great count of new highs in only the first 2 months of the year, full year return 15.7%, and a batting average or frequency of advance up 91% of the time. Compare that with the very bottom row called all years, and that's the average for every year going back to World War II. So the market typically gained 9% in the full year, was up 3 out of every 4 years, but 3 out of these 4 indicators were very, very strong. Second indicator being first quarter low was not below the prior December's low. Whenever that's happened, we've been up more than 18%, 95% frequency of rising on the full year. And also it was in the top 10 number of times that the equal weight 500 posted a year-to-date return through April. And in this case, the market indication was that we'd be up 20% for the full year, 91% of the time. Looking at the blue shading, that's the average for all of these milestones in the second half. Average is 5.9% versus 4.5 for the market in general. Frequency of advance 73% versus 70. And then fourth quarter seeing a bit of a pop as well. So 4.9 being the average versus 3.9. and just a shade better with an 80% frequency of advance. So now you know what we got the title for the presentation, Strong Starts, Favorable Finishes, that usually we end up ending well if we start the year quite well. If we go to the next slide, we can see why investors might feel optimistic about the remainder of this year. Global real GDP is expected to rise 5.4% this year, but remain strong in 2022, up 4.6%. U.S. GDP up 6.2 this year, 4.4 next year. And yes, we do think that inflation will be on the ascent. Core PCE, personal consumption expenditures, the indicator that is favored by the Fed, is expected to be up 2.8% this year, but then moderate as we head into the next calendar year, averaging 2.4% for the full year. Our economists don't think that the Fed will be raising rates this year or next year, despite what James Bullard hinted last Friday on financial TV, that maybe there's a possibility the Fed will start raising rates by the end of 2022. The 10-year note, we think, will average 1.62 for this year, but get up to about 185 by the end of 2021, and then average just a little more than that in 2022. So really just sort of climbing back to what the long-term average is for the 10-year note. The dollar is likely to weaken slightly this year and then again into 2022, yet oil prices are likely to remain fairly strong. If we go to the next slide, we can see that, not surprisingly, if economic growth is expected to be favorable, well, so too should earnings. The blue shading shows the full year for the S&P 500 sectors, the 500 itself, mid and small cap indices, as well as the developed international and emerging market BMI, or broad market index. And you can see that while the second half is expected to be good, it's obviously not as good as the first half in terms of earnings growth, because we're coming off of that COVID lockdown. So not surprisingly, that a 20% gain in the third quarter, 17% gain in the fourth quarter for the S&P, resulting in a 32% advance for the full year. Well, you can almost double that earnings growth and see what the 400 should do, triple that to see what small caps should do, and both developed and emerging markets expected to see stronger earnings growth than here in the U.S. on a large cap basis. And this is expected to carry on into 2022. Double-digit growth for the 500, for the small cap 600, as well as developed and emerging markets. But into everyone's life, a little rain must fall. And right now, the gathering clouds that investors are worrying about is inflation. As we see in the next slide, going back in time, the market has remained fairly resilient when we have been seeing monthly increases in the year-on-year percent change in headline CPI. Going back to the 1950s, as you can see in the top right box, what I did was I showed where did this year-on-year change start. So in the 1950s, the very first month of 1950, we had an 8% gain in year-on-year headline CPI. Yet by the end of the decade, we were at 1.4%, averaging 2.1 for the full 10-year period. Yet in that period, when we were having good economic growth and a decline in inflation, the S&P 500's compound annual growth rate was 13.5%. So usually the downward slope in inflation is fairly positive for equities, yet the reverse, as seen in the 1970s, we started the decade at 5.3%, ended at 12.4%, the average being close to 8%. No wonder we eked out only a 1.6% compound annual growth rate, and Fed Chair Paul Volcker decided that the Fed needed to strangle inflation in order to allow the stock market and the economy to continue to improve. So what we show in this bar chart, however, is by looking at all of the different monthly percent changes in rising CPI, breaking them into quintiles, how did the market perform in those quintiles? And not surprisingly, the higher we went with inflation, the lower the monthly return was for the S&P, with a line in the sand between growth and either being flat or negative being around 4%. Well, we are obviously above that right now, but the feeling is that it's likely to be transitory, and so we're giving, in a sense, the Fed the benefit of the doubt, even though we are monitoring stock market performance, because traditionally prices lead fundamentals. So let's take a look at the next slide. What should be the better performing sectors when we do start to see increases in headline CPI that is fairly consistent? The way this chart differs from the one I showed earlier is that this would include those periods in which the Fed was raising interest rates. So not just a steepening yield curve, but looking at all periods in which we had rising CPI. Again, energy was in front. Materials also did fairly well, as it did before. But look at technology, small caps, real estate, ending up acting like inflation hedges, whereas healthcare, consumer discretionary, financials end up being the underperformers, because as interest rates rise, at least for discretionary and financials, we find that we have a shrinking yield curve, which makes the banks less profitable. Consumer discretionary causes consumers to say, maybe I'll postpone some of my purchases. So if we think about what decade had the worst period of rising inflation, obviously it goes to the disco decade of the 1970s. Let's take a look at the next slide, and we'll see that in that entire 10-year period, looking at those months in which we did have a rising interest rate, which were the better performing sectors, and then which were the better performing sub-industries, and which stocks today have the highest CFRA stars ranking within those sectors and sub-industries. So energy, materials, real estate were the best performing, as we see on the far left, during the decade, in those months in which we did have a rise in the 10-year yield. The market itself during those periods was negative, as was financials. Staples was flat. Healthcare and utilities were also relatively flat. But if you look to the right-hand side, you see, not surprisingly, gold and precious metals did well, and with the average monthly return of 3.9%. The highest ranking gold stock, followed by CFRA equity analysts, is Newmont Corp, with a recent price of 71 and a 5-star or strong buy ranking. And then you can see aluminum, oil and gas drilling, etc., all the way down. So these 12 sub-industries were the best performing in the 1970s, then with some names to go along with them. But what about today? Let's take a look at the next slide, which shows which are the strong sectors today. I like to look at a rolling 9-month relative strength, which is similar to a 200-day moving average. And what I show is the top 4 are given a plus, and I also highlight with green, like a stoplight. The middle 3 is 0 for neutral, and then the bottom 4 is a minus, and also with a red coloring. This tends to perform relatively well, as you can see the very bottom box showing the 3-year compound annual growth rate for the 500, 400, 600, European 350, and Asia Pacific indices, by emphasizing the winners and sort of avoiding the losers. You've been able to outperform the respective benchmarks. But today, the strength across the board, energy, financials, and to a lesser extent, materials and consumer discretionary. Weakness, however, in staples, healthcare, and utilities. So at least this is where the trend is implying we are headed. The next slide gives us a little bit of positive sense that maybe this bull market can last a little longer, because there is so much participation, buoying breadth, as I call it. 97% of the 147 sub-industries are above their 200-day moving average. So that implies that, hey, if you've got a carriage that's being pulled by 20 horses, you have a better chance of getting to your destination intact and ahead of schedule than if you're only being pulled by 2 horses. So in this case, we are looking at a fairly broad participation So a great number of horses, if you will, carrying this market forward. My last slide is just a summary. I like to tell you what I'm going to tell you, and then tell you what I told you. And in this case, saying that, yes, 2021 has the potential to be a positive year. At the end of May, we updated our 12-month price forecast for the S&P 500, it now being at 4620. That's the 12-month target. And by implication, the end of year target becomes 4444. So I guess may the fours be with you. Market continues to look forward to rising GDP and earnings estimates. Yes, investors will cast a wary eye to inflation projections and long-term interest rates, but our belief is that the cyclical sectors that have performed well should continue to perform well, but advise corrections are inevitable. We've gone about 270 plus days since the last decline of 5% or more, and historically it's only 177 days that separate these 5% plus declines. So corrections are inevitable. However, I emphasize you are much better off focusing on recovery time, or in other words, you are more frequently, it's best to buy than it is to bail. Now to give you some ideas as to where to do some buying, I turn the presentation over to Elizabeth Vermillion, who will talk about U.S. infrastructure impact.
Thanks, Sam. So now we're going to look at U.S. infrastructure impacts for the construction, machinery, and heavy truck sub-industry, as well as the construction and engineering sub-industry. And I'm broadly going to refer to those as construction and machinery together. So here's a look at what we're going to talk about today. We're going to cover what's in scope for construction and machinery. We're going to look at a recent timeline and review of U.S. federal infrastructure discussions. Then we're going to take a look at the current state of U.S. infrastructure, followed by our outlook for 2021 and 2022. Then we'll wrap it up with some risks to the sub-industries as well as some actionable ideas. So on the next slide, we're going to be focusing our analysis on the time frame starting with the 2016 presidential election through to present day. Over this time period, the construction, machinery, and heavy truck sub-industry has generally outperformed the S&P 500, as well as its industrial peers in the construction and engineering sub-industry. The construction and engineering sub-industry has faced some challenges due to volatility and some accounting challenges at one specific company floor, and then also due to the loss of the strong performing Jacobs Engineering to a different sub-industry. So then moving on to slide 23. The year-to-date, the construction and engineering and sub-industry is up 20.5%, and then construction, machinery, and heavy trucks is up 9.8%. And this is compared to their wider industrial peers up 12%, and the S&P 500 up about 11%. And all four of these percentage changes are a little bit lower than they were if we were having this discussion a week ago. Last week was a tough week for some of these, especially the industrials names. But in both 2021 and 2022, we're expecting the construction, machinery, and heavy truck sub-industry to trade relatively cheaper than their industrial peers, as well as the wider market. Where in 2021, we're looking for robust earnings growth to be supported by strong demand for equipment that's really going to be driven by the economic recovery we're seeing post-pandemic. In 2022, we're going to continue to see strong earnings, we believe, though there might be some challenges facing due to prior year challenging comparisons for this year. So on the next two slides, we are going to show the constituents of each sub-industry, and this is based on market cap. So within construction, machinery, and heavy trucks, the main companies are Caterpillar, Cummins, PACCAR, and Wabtec. So these companies manufacture a wide range of machines that's used in construction, trucking, locomotives, as well as mining applications. And then in the construction and engineering sub-industry, we do still include Jacobs Engineering in our peer group when looking at this sub-industry, even though they have, within the last few years, moved to a different sub-industry. And some other major players are Quanta Services, AECOM, and MasTec. So companies within this space specialize in project and construction management, as well as engineering services. So now we're going to shift a little bit and look at the Democratic platform priorities. And so these are some of the goals that were outlined in the 2020 presidential election campaign platform. And these are things that we're expecting to positively impact the construction and machinery sub-industries. And this is going to be accentuated if there is a federal infrastructure spending plan that's passed. So in the very near term, we expect to see laws that would be passed for tax credits and tax benefits. And these are going to encourage increased production of and purchases of electric vehicles. So we believe that as technology for electric vehicles, specifically cars, improves, we expect then a transition to trucking and other large vehicles who are able to piggyback off those advancements for cars and adopt them to their larger applications. In both the ongoing near term and in the long term, we see benefits from expected increases in research. And so this research is going to, we believe, to be specifically in battery technology. And we think that this is really going to drive benefits for the construction machinery and heavy trucking companies. And just a federal infrastructure spending plan would only serve to accelerate those investments. So looking at some of the recent major infrastructure proposals under both Biden and Trump, again, the timeframe here is 2016 presidential election to current day. Federally funded infrastructure spending was a huge leading issue in the 2016 campaign, as well as the 2020 presidential election. Former President Trump outlined a $1 trillion infrastructure spending plan, and this was something that received a lot of support in 2016. Roughly 2/3 of voters approved of this spending plan. It was, a rough outline. After being elected, though, the source of funding came up for discussion, and this is kind of where support began to back down a bit. It turned out that the proposal had a lot less federal funding than most people were expecting. There was a lot of private funding. Over the course of President Trump's term, a few other infrastructure spending plans were proposed. But again, the funding source was typically very little federal funds and mostly private funds. And so even though there's a lot of bipartisan agreement that federal infrastructure spending is essential and is a near-term need, the source of funding continues to cause delays. And then also there have been competing priorities under Trump, such as discussions about a border wall. And then, of course, the COVID-19 pandemic really put a pause on a lot of the infrastructure spending talks. So then in the 2020 election, federal infrastructure again was a main pillar of both parties' campaigns, just behind more COVID-19 pandemic relief. So in 2020, the difference between 2016 is that this time, the Democratic Party especially was presenting infrastructure spending with a green tilt, so zero emissions, electrification, trends like that. So again, the source of funding continues to be a roadblock. As you can see, there's a lot of different plans that have been proposed here. None of these have been passed yet, and pretty much always the roadblock is funding. Republicans feel that a few of the Democratic proposals have been a little bit too wide in scope, including things that were non-infrastructure related. And then Republicans have pushed for funding to leave corporate taxes alone and instead have favored things like a gas tax or redirected COVID-19 relief funding. President Biden has suggested a corporate tax increase to 28% from the current 21%, and then also a potential levy of tax on foreign earnings of U.S. companies. So while it is possible for the Democratic Party to pass federal infrastructure spending for the budget along party lines, this is something that the president wants to ideally be a bipartisan plan, and we think that that's something that would really help into the future. If more people are agreeing on the plan, it's going to be easier for project work to get done. It's going to be easier for states to accept different funding goals if their representatives were more on board with the plan. So even though there have been a lot of debates, we do think that there is going to be a federal spending plan passed in conjunction with the 2022 budget. Most recently, there is a bipartisan plan from 10 senators. And so there's a lot of hope that something will get passed in the near future. So looking at the next slide, we're going to just drill down into where funding comes from, which I mentioned a little bit on the last slide. So using redirected COVID-19 funding, the total amount would be roughly $350 billion from the previous $1.9 trillion economic relief package that was passed in March, and this could be redirected for infrastructure project work. This is something that is a funding option for the bipartisan plan. Biden has mentioned that he's okay with maybe using like $75 billion of the redirected COVID relief, but doesn't seem on board yet for the full $350 billion. Another option is an increase on the gas tax. So this is something that's not very supported by Biden and Democrats. This tax has not been increased since 1993. A proposal is for the gas tax that's currently 18.4 cents to increase at the rate of inflation. And this is, again, something that the bipartisan group is considering as an option for funding. Most of Biden's early proposals have included funding from corporate tax growth, but this is something that at this point really seems to be a complete roadblock to getting a spending package passed. We don't expect corporate taxes to increase. A more likely tax would be the levy on foreign earnings for U.S. companies, and so that would be a 15% tax, and it would only be levied on companies with $2 billion or more earnings, $2 billion or more in earnings. Okay, so then we're going to take a look on slide 29 at the current U.S. infrastructure scorecard. So this scorecard is published by the American Society of Civil Engineers. It gets refreshed every 4 years. And so the minimum grade of B is what is required for a category to mean a good state of repair. And so as you can see on this most recent scorecard, a grade of C- is well below that. C- is a slight increase from the 2017 score of a D+. And we really feel that most of this growth, this improvement, has been driven by state and local spending in the absence of a federal infrastructure spending plan. Over this 4-year period, 5 categories did post improvement, as you can see based on the coloring here, but 11 categories remained in the D range. And so that's just making it very clear that the need for federal infrastructure spending is still very high. So slide 30 aggregates all of the total funding that is needed to get those scorecard categories up to that kind of minimum passing score of a B. And then it's overlaid with project work that is already funded, and then our forecast for funding if Biden's 1.7 trillion American jobs plan was to be passed. And so we're using this because they have a breakdown of how much funding would go to different categories. So even though we think that 1.7 spending plan is unlikely, this is just a kind of a rough estimate of remaining funding that would be necessary even after federal infrastructure spending plan. So notably, it is possible that the electricity category could reach full funding. So that would be projects that are high on many politicians' lists, such as improving broadband speed and modernizing the infrastructure grid, the power infrastructure grid. So we really feel that federal funding of any level is going to help bring US's infrastructure closer to fully modernized. So even if there are still funding gaps, that doesn't mean that the plan was ineffective. You know, any improvements are improvements, and so will bring infrastructure up to date in a way that is beneficial for the economy and for all users. We see companies like Caterpillar, Cummins, Terex, and Oshkosh specifically benefited from a lot of that funding you see in that first category, surface transportation, the biggest category. And so a lot of these infrastructure spending companies that we are looking at here today are really set to benefit from that category of funding. So before we move on to some more company-specific ideas, I did want to go over some risks related to infrastructure spending. So we have some low probability risks and some more likely risks. Low probability would be that there just never is infrastructure spending plan, which we think is highly unlikely. And then also that there could be renewed COVID spikes that lead to shutdowns again, which would of course delay project work. And then some more likely risks would be that there's just continued delays in passing a plan due to the disagreements over funding. As projects are decided upon and there is a spending plan, it takes time for project work to actually begin. Companies need to be chosen for the work, equipment needs to be ordered. So we estimate an 8 to 12 month lag in when you'd really start to see a lot of the benefits for these companies. And then also, it's possible that the funding estimates could be too conservative, as the debates continue on and on, infrastructure ages. So as time goes on, more money is needed to get everything up to a more modernized level. So then I'm going to wrap up with some actionable ideas for both sub-industries. So the three that I will highlight for construction machinery and heavy trucks are Caterpillar, Cummins, and PACCAR. We have a buy rating on all of these. So Caterpillar, we estimate, has about 29% of their revenue exposed to applications from U.S. federal infrastructure spending. Cummins, our estimate is that about 39% of their total revenue is exposed to infrastructure spending. And then for PACCAR, it's a smaller percentage, but we see that their main area of benefit would be zero emission truck production. They do have some trucks that they think they're going to be able to get into production and out into the market this year. So that would be something that, again, investment money would be great for their research division. And then finally, to wrap up, some ideas for construction and engineering, Jacobs Engineering and Quanta Services. These are two of the leading project management and engineering companies. We think that Jacobs has a really great relationship with working with the government and its agencies, so they're going to be often a first choice for a lot of these project works, and they do a lot of work with green initiatives. Quanta Services, their benefits are going to be more on the power transmission and electrification side, so that's things like 5G, building out the electric grid in the western part of the United States. And so they're really set to build from the electrical side of federal infrastructure spending. So with that, I'm going to pass it over to Richard to talk a little bit more about materials and chemicals.
Thank you, Elizabeth. So before we get into chemicals, let's go ahead and take a look at the performance of the materials sector on the next slide. So as we can see, materials were underperforming the S&P 500 for the 2 years prior to the pandemic. And then after bottoming out in March of last year, materials have outperformed. And we think a lot of this can be attributed to infrastructure headlines and faster than expected recovery in foreign production, which has caused stocks to run up. However, we think there's still more room to run for the sector, given its pro-cyclical nature amid a recovering global economy, along with some catalysts that we'll cover later. For now, let's jump into the next slide for some context on why we want to talk about chemicals. All right, so this tree map breaks out the sector by market cap. And the reason we're focusing on chemicals is because it makes up most of the sector's market cap, roughly 70% to be more precise. However, for being such a large component of the materials sector, we believe chemical companies sometimes go overlooked compared to other materials constituents like steel and copper. As we move on to the next slide, we can see that the broad market has mostly outperformed chemicals on a 3-year basis. However, year to date, all but specialty chemicals have outperformed as the cyclical value plays have benefited from economic recovery expectations. So let's get into more details on some of these sub-industries on the next slide, please. All right, so here we have a quick overview on 4 chemical sub-industries, their composition, and some key numbers. Starting with commodity chemicals, we can see that based on the lower multiple relative to the chemicals peer group, as well as a high dividend yield, this is where you would find more of your typical value stocks. This is different than specialty chemicals, where you'd be more likely to find growth stocks compared to the entire group. And while we can make an argument for a recovery play for specialties, we see more potential from long-term growth trends in this sub-industry, which we will cover later. As we can see, diversified chemicals and fertilizer and ag chemicals are trading closer to the commodity group, likely caused by the commodity nature of some of the products that are sold in these 2 sub-industries. And we can dive into more detail starting on the next slide, which covers some of the macro implications. So we think chemicals can be a good equity play on inflation fears, and it's not a perfect hedge because chemical producers, like many cyclical companies, are sensitive to broad market trends and conditions. However, we think chemical producers fare better in an inflation environment due to its relationship with 1, actual commodities, and then 2, energy, which Sam pointed out is generally the highest performing sector in this kind of environment. And as we can see from the chart on the right, chemical producer prices have increased significantly, which has spilled over into some of the downstream markets. Additionally, chemicals are generally more upstream in the supply chain and serve as an input to industrial production. And this is illustrated in the chart on the left-hand side. And what we can see is the leading nature. Where chemical production goes, which is highlighted in blue, we can expect industrial production in orange to follow. This chart indicates that we are going into an economic expansion with year-over-year chemical activity up 12% in April and 19% in May. And that said, while the global recovery outlook has become more solidified due to widespread vaccination efforts, we believe the key question on investors' minds is related to the transitory nature of current inflation. And we can go into more detail starting on the next slide. So like many other industries, chemical plants reduced capacity at the onset of the pandemic only to be met with higher than expected demand, which resulted in a supply and demand imbalance and ultimately driving commodity chemical prices higher. The supply conditions got even tighter when Winter Storm Uri came rolling through the Gulf in February and caused plants to shut down unexpectedly. And to look on the demand side, as we've already mentioned, chemicals are pro-cyclical, and we want to focus on some of the end markets that are more important to the chemical producers we cover. So this includes construction, auto production, packaging, and general durables. And to sum up our bullish downstream views, we acknowledge robust home building trends, which we expect to stay positive, recovering economy trends, which, paired with consumers flush with cash, will help maintain some of the durables trends that we've seen. And then lastly, you have remote working and e-commerce trends to keep consumer packaging trends high. So lastly, we want to point out that global GDP is expected to grow at above average rates in 2021 and 2022. To give some clarity, we jot down some of the chemicals and their primary purpose on the left-hand side of the slide that can generally be applied to most of these end markets. So you have titanium dioxide, which is a raw material for coatings, and these need to be applied to generally everything in these categories. You have your isocyanates like MDI and TDI. These are used in flexible and rigid foams, ranging from insulation material to shoe insoles. Chlorine is a feedstock in vinyl production, which is used for building material markets. And then you have olefins, used heavily in consumer packaging and plastics in various end markets. All in all, the recent supply tightness and subsequent price increases have given commodity and diversified chemical producers an opportunity to favorably allocate capital with rising free cash flow. Some companies have committed to deleveraging their balance sheets, maintaining solid dividends, and pursuing M&A. However, the question is, how sustainable is this? Next slide, please. So we can see from the graph on the left that spot prices for polyolefins were recovering under tight supply conditions until really taking off in February because of Winter Storm Uri. We expect demand trends to remain strong, as we highlighted on the last slide, but margins are not expected to maintain this strength going into 2022. Capacity is expected to normalize in the back half of the year. We believe foreign capacity will come online over the medium term, and as a result, we think prices and margins will normalize for petrochemical producers. On the next slide, we can do a brief overview of our actionable ideas. So first, we have Chemours at a strong buy, which we believe the stock is underappreciated as titanium dioxide prices have bounced off their lows and have given the company an opportunity to increase free cash flow and reduce debt and repurchase shares. We also see more upside in Dow, also a beneficiary of increased infrastructure spending given the company's diverse segment base, including polyurethanes and construction chemicals. Dow also has a strong dividend yield of 4%. Eastman is going on its fifth straight year of having free cash flow over $1 billion, allowing the company to achieve favorable debt reduction and repurchase shares and pursue bolt-on acquisitions. And then for Huntsman, we believe the end market growth using MDI will help sustain earnings going into 2022. We also believe the company's ability to transition to more downstream applications has also been overlooked. And then lastly, we have Olin, a strong buy. We believe this company has a strong management team, a well-diversified portfolio with chlor-alkalis and ammunition. It's also in the low end of valuation. And then given the strong year of EBITDA and cash flow ahead, the company is remaining disciplined with its free cash flow, targeting debt reduction. On the next slide, we want to highlight catalysts that we think are not fully priced into some of the companies under our coverage. And, we can start with infrastructure. When people think infrastructure, they generally think of some of the traditional investments like roads, bridges, ports, et cetera. And increased infrastructure spending would be a demand boost for chemicals, namely industrial coatings and building and construction materials for these traditional projects. However, we want to expand this to the initiatives, including under federal spending possibilities that Elizabeth talked about earlier. So this includes 5G infrastructure, which bodes well for semiconductor demand and companies like DuPont that manufacture semiconductor fabrication materials. You have clean water initiatives, which also bodes well for DuPont water treatment products. You also have the accelerating growth of electric vehicle production, which we believe opens up the opportunity for lightweight plastic producers like Celanese. On the environmental side, this is where a lot of specialty and diversified chemicals can differentiate themselves in our view. So for one, you have companies like Eastman at the forefront of recycling technologies. You have companies like Chemours, which are manufacturing zero greenhouse gas emission refrigerants, which we think will likely gain traction as F-gas refrigerants are phased out of production and use. And then lastly, we have green hydrogen, which has become a hot topic as governments seek to reduce their carbon footprints. Let's go into more detail about one of the trends that made a lot of headlines in 2020 on the next slide. So we're talking about lithium, a raw material and battery production. And the gap between global lithium capacity and lithium demand is expected to close at a dramatic pace as battery applications grow. And one of the main catalysts is electric vehicles, which is positioned to accelerate market share as car manufacturers try to catch up with Tesla, and electric vehicles achieve price parity with internal combustion engine vehicles. What we are seeing now is that lithium producers are increasing their capacity in anticipation for this growth. And recently, we've seen companies like Albemarle and Livent fund this growth by issuing shares after their valuation saw a significant boost over the last 12 months. However, despite the capacity build out, which can be a very lengthy and costly process, we think demand will outpace supply additions, which will cause lithium prices to rise further. And we can see from the chart that lithium prices are already at an inflection point, which bodes well for lithium producers' profitability. Next slide, please. So looking at some of the specialty chemicals we cover, we think the best opportunities include Albemarle and DuPont. And for Albemarle, we already covered where investors' main focus is, which is lithium, and point out that their increased capacity should drive top and bottom line growth going forward. And then you have DuPont, which has become more nimble after selling off its nutrition and biosciences segment. And we see an attractive valuation as the company continues to grow on the higher growth electronics side. Next slide. So lastly, we want to cover some of the trends in agriculture. This is another area of the chemical industry where investors can get an indirect exposure to commodities that are part of the inflation trade. And we've seen agriculture commodities like corn and soybeans prices rise significantly in recent months. And this stems from supply not being as strong as expected and imports from China seeing a significant boost, which isn't expected to slow down going into next year. So any upward adjustments to these numbers could have a positive impact on corn prices. And some other potential catalysts include reduced corn production in Brazil on drought pressures. And additionally, the U.S. has also seen some drier weather in the West, which could impact yields. And all this said, we think prices will stay elevated given our view that it will take a few years to normalize this end stock to use balance. So let's move on to the next slide and talk about how this converts to our fertilizer stocks. All right, so on this slide, we can see that all three fertilizers made a pretty significant recovery starting in Q3 2020. Demand side is looking strong as farmers are less likely to reduce usage of crop inputs like fertilizers and crop protection because they want to achieve better yield as commodity prices remain high. You have the urea tenders in India has also been a large part of the growth story for nitrogen. And then recent news in potash, which is Mosaic closing down 2 of its mines earlier than anticipated. And you have the EU sanctions against Belarus. This is driving a tighter potash market. And as a result, you're seeing companies like Nutrient boost its potash production, and which will benefit their earnings. So next slide, we can talk about some of our actionable ideas for the space as a whole. And we're bullish across the entire sub-industry, mainly because of the positive fundamentals we just talked about. But we can go ahead and highlight our strong buy, or one of our strong buys, FMC, which we believe has a strong geographic balance and a lot of crop diversity. And this company has a strong R&D pipeline, bringing various ingredients online in the medium term, which we think will drive earnings growth. We also believe its shares are attractively valued compared to peers. So at this time, I'm going to pass it off to Todd to talk about ETFs.
Thanks, Richard, and it's a pleasure following you and Elizabeth as we'll move to the next slide here. The way that we at CFRA do our ETF research we'll focus on what's inside the portfolio and how that looks from a risk and reward perspective in a forward-looking approach, as opposed to just relying on past performance the way that others within the industry are doing it. We'll move to the next slide if we can to just talk about how strong the demand has been for ETFs. We are on pace to blow away what was an impressive year in 2020 for net inflows for ETFs. You can see we've already passed the $400 billion mark, not even halfway through the year. And for equity ETFs, we actually have already exceeded the net inflows for all of 2020. And fixed income ETFs are at a slightly behind pace, but likely to pick up again. And we could see another record year for fixed income ETFs. Our clients, the audience, as well as the broader marketplace, is increasingly using ETFs to get the benefits of diversification and to be able to be tactical with their portfolios. On the next slide, we're going to just show you a few different sectors and go a little bit deeper because we're talking about sector, and we'll mention a couple of thematic-oriented ETFs. And we've seen strong demand. We've already, again, exceeded the overall flows for U.S. sector-oriented ETFs, particularly value-oriented ETFs like financials and energy have been popular. What we refer to at CFRA with our ETF database as factor and thematic ETFs. You can see global as well as U.S.-oriented ETFs. Global is combining U.S. and international stocks together. Have been extremely popular, both actively managed as well as index-based products, and we're continuing to see adoption. If we can move forward one more, Don, we're going to just show you a few different examples of why what's inside the portfolio matters using some of our recently published research. This is MTUM, which is the iShares Momentum ETF, which had a growth focus prior to its most recent rebalance. We wrote about that we thought it was going to be moving away from companies in the technology sector, particularly Apple, Microsoft, and NVIDIA, because of the performance, relative performance weakness. And we identified that financials and energy stocks would be increased in overall portfolio. We actually underestimated how much would go into financials. You can see it's more than 30% of the portfolio. But also, as it fits into the comments that Elizabeth and Richard made, we've seen an increase in the exposure to industrials and materials as those more cyclical sectors have performed better. We can move forward one more, Don. This is an example of an industrial ETF, transportation in particular. This ETF, IYT, is moving to a new benchmark in July. We wrote about it at the end of April and May with our overall research, looking at what was going to change within the portfolio, including adding in companies like Uber and Lyft that weren't around decades ago when this index was constructed, and how we'd see reduced exposure to or from FedEx and Norfolk Southern, with a number of other stocks seeing an increased weighting, as you'll see on the left-hand side of the slide. If we can go one more, Don, this is going to highlight about infrastructure ETFs that both Richard and Elizabeth talked about, infrastructure and how it fits into their sectors. PAVE, P-A-V-E, is a Globalx US Infrastructure ETF, which is the most appropriate way to get exposure to the themes that we've been talking about. And you can see it had significantly outperformed IGF, which is an iShares Global Infrastructure ETF, which has much less exposure to U.S. companies. And you can see EXI, which is a global industrials ETF. So being targeted, focusing on this theme for the reasons that Elizabeth highlighted very extensively, adds a significant value. It has added value, and we continue to like PAVE going forward. With that, I think I'm going to move us to one more slide, which is going to tee up the question and answer session. And Ken, I'll turn it back to you and stand by if there's questions that fit in from an ETF perspective.
Great. Thanks, Todd, Richard, Elizabeth, and Sam. And using the chat function, you can send us your questions. First one for Sam is, with last week, the Fed obviously was a little of a scare. Is the cyclical trade over? because that was such a strong area of investing over the last 6 months or so.
Right. I don't think the cyclical trade is over. I got a question yesterday in the financial media where somebody asked, was it Fed Chair Powell who sent the market into a tailspin? And I was thinking, no, it probably was more Fed President James Bullard who was floating the trial balloon of how would the markets respond if there was a possibility of the first rate hike occurring in 2022. But if you also look to the dot plots, the feeling is we're probably only going to have 2 rate increases in 2023. And so the feeling is that with interest rates being as low as they are now, comparing it with history, we'd have a long way to go before we would really end up spooking the market in general and spooking the cyclical trade, if you will. Because if we look to the cyclical side of the camp, we are expected to see about 33% earnings growth this year for the S&P Value Group versus 24% growth. And also looking at valuations, they look a lot more attractive on the value side. Looking out even into 2023, a PE of only 16 for the value side versus 26 for the growth side.
Sam, also, you're highly noted for your work on seasonality and sectors, and coming out of the pandemic, things might be different this time, but any observations just on the seasonal rotation of sectors?
Well, the investors have been sticking with stocks, usually in the May through October period, because the market does, in a sense, go through a zigzag pattern. Investors tend to gravitate toward the more defensive areas of the market. We've been seeing real estate do well. We've also been seeing healthcare and staples hold up quite well. But usually they do a lot better when we do go into some sort of a tailspin. We're entering into the third quarter, which is by far the worst of the 4 quarters fairly soon. And the 2 months that have posted average declines for the S&P include August and September. So obviously history is a guide, it's never gospel, but if there is some sort of additional volatility to be had, investors probably will end up embracing the more defensive side of the ledger.
Elizabeth, let's talk about federal infrastructure legislation, and if passed, when can we see the benefits that for the industrial sector or companies, and would stocks reflect that as well ahead?
Hey, yeah, so in terms of would stocks reflect that ahead, we do think that in general infrastructure spending is priced into the market, but there is some additional upside once specific project work funding is announced. So once you see how much money would be going into road building and companies start getting selected for project work, we see additional upside for those names. In terms of timing, there's a lot of immediate benefits. There's a lot of benefits that are ongoing over 1, 2, 3, 4, 8 years. And then there's some longer term benefits down the line. Some of those things would be the goal of by 2030 having 0 emissions. And then on the other hand, some more near term benefits would be, like I mentioned earlier, tax benefits for electric vehicles. And then, you would see within a year or two, some of those projects, as they start to kick off, you would see the equipment involved. That's when you would see that spike in demand, which would, translate, we believe, to revenue growth for a lot of the companies we mentioned.
Right. And Richard, just speaking of, there's so much on sustainability and renewable energy, and even in your space, what we're seeing most recently is the topic of green hydrogen, and just wondering how does that play into your coverage of the chemical companies, and whether this is yet something that could be a game changer looking ahead.
Yeah, thanks for the question. So I think there are 2 ways to look at this. You have the chemical side and then the industrials gas side. So from the chemical side, there are companies that support green hydrogen production and end market use. So for example, you have a company like Chemours that manufactures membranes used in fuel cells and electrolyzers, which, while not a significant portion of sales, has a lot of upward potential as the industry really takes off. And then on the industrial gases side, you have Air Products and Chemicals, which is ticker APD, and Linde, both undertaking projects to produce green hydrogen. And you also have CF Industries, which is one of the fertilizer companies, is also pursuing green ammonia, utilizing an electrolyzer at one of their plants. So as renewable sources scale and electrolyzer costs fall, we expect green hydrogen to play a bigger role in global decarbonization, and for stocks that are investing in hydrogen production or fuel cell materials to benefit.
So in materials, Richard, you know, it's an area where things can change quickly, and just kind of level set. Have we reached peak margins in 21 and perhaps earnings, and maybe being forward looking to 2022 to earnings? What's your take there? And then of course, bring it back to stock prices.
Right. Yeah. So I think this is an important question because for some companies, we expect a year-over-year step down in earnings going in 2022. And this is primarily for commodity chemical names and fertilizer names that have seen a significant price increases for their products. I do not think the market expects a continued step up in earnings. And I think the step down is reflected in current valuations. Because these price increases aren't necessarily tied to operational issues as much as they are exogenous events like weather. So when we look at, you know, the multi-year, the 2022 and the 2023 outlook, we're really starting to compare it to 2018 and 2019. You know, kind of leaving 2020 and 2021 as these outlier years, and it looks favorable going ahead. And then this is different for specialty and diversified. Which for the companies we have buys on, we do see year-over-year growth.
Great. Todd, a lot is going on with ETFs, not only in terms of fund flows, but then also the construct for many of these ETFs. And I want to go back, you showed examples of shifting holdings for ETFs. What does that mean, and how common is that for passively managed funds?
So most ETFs track an index. In fact, it's 96% of U.S. listed ETFs are index-based. Indices range from something like the S&P 500 that is relatively static and will add a dozen or so companies throughout a given year and have relatively low turnover, to something like the momentum ETF that we highlighted that rebalances semi-annually but based on market sentiment, or ETFs that rebalance on a monthly basis. There's a handful of those ETFs. So it's important to know how often your ETF rebalances, and then to check rather regularly to make sure that what it holds is still consistent with what's in the portfolio. The way that we rate ETFs is based on the last month's worth of holdings as opposed to a static portfolio. And so our research helps our clients be able to look inside and understand the risk reward characteristics of the portfolio, because they're not as static as many people seem to think.
Great, Todd. And for today on materials ETFs being actionable as we are at CFRA, can you highlight any of the appealing ETFs for this sector?
Sure. So the largest and our favored one in the space happens to be the Materials Select Sector Spider ETF XLB. This tracks the S&P 500 materials sector that Sam talked about and that Richard went in depth on. It's heavily weighted towards chemicals because chemicals is the largest from a market cap weighted perspective. Another ETF that is offered by Vanguard is Vanguard Materials ETF VAW. That's a bit more multi-cap in nature, so it'll have some small and mid-cap companies outside of the S&P 500. Those are two good ways to play the themes that Richard was talking about.
And Todd, regularly through the year, is also featured for CFRA webinars just for ETFs, and very often brings ETF fund providers on as well. So look for that again in the near future. Sam, back to you on equity strategy and consumer staples, defensive, maybe income oriented, but is it an inflationary hedge or not?
Not really. If you recall the slide that I showed, one of the last ones talking about the disco decade, basically it indicated that consumer staples were among the worst performers. It was posted a flat performance in the 1970s when we had higher interest rates in a steepening yield curve environment. Consumer staples were sort of in the middle, but at least to the lower side of the overall market. And then looking exclusively at inflation, they're in the middle of the pack as well. So staples, healthcare, utilities are usually more defensive in nature, and they're the ones that fall less than the market as a whole during market declines. But if you're looking to outpace inflation, that tends to be energy, materials, real estate, and surprisingly, technology has done relatively well.
Sam, last question for you, just related to any concerns in terms of when did we last see for the market or the S&P 500 a correction? And given perhaps the duration that we have not seen one, does that pose, any risk to volatility? And knowing that, we have a target, for 4,600 plus, looking by, out over 12 months. If you can just bring that all together.
Sure. Well, we have had more than 60 pullbacks or 5 to 10% declines within bear markets going back to World War II. We've had about 25 corrections, which are 10 to 20% declines. Looking at the time between the end of pullbacks, corrections, and even bear markets, on average, the market rises about 177 calendar days. Well, we've gone more than 270 calendar days. Doesn't mean that a correction is right around the corner, because in the past, we've also gone as long as 780 days since a meaningful decline. So, it just implies that on average, expected the market to stumble, about at least once every 9 months or so. But as I said before, I would focus more on the speed to recovery. On average, it's taken only a month and a half for declines of 5 to 10% to get back to break even, and an average, believe it or not, of only 4 months to get back to break even following declines of 20% or less.
Great, thanks, Sam. Next slide, please, Dawn. Want to thank each of our presenters for just a great run through in terms of the second half outlook. Sam, Elizabeth, Richard, and Todd, great job today. And to get additional research from any of them, you can visit Market Scope Advisor. Down below, you can see how to access with our website, and you can get additional information from the presentations as well, as you can see on the right here. I want to thank everyone for taking time from your valuable schedule to be with us today, and look for future webinars that we'll be planning in the third quarter. Thank you again, and be safe and healthy. Take care.